Hey everyone, today I would like to analyze Jollibee Foods Corporation. For those who might not be familiar, Jollibee is a major player in the fast food industry and comes from the Philippines. With a market capitalization of around $4.3 billion and a dividend yield of over 1%, Jollibee presents an interesting case for investors. Let's explore what makes this company stand out and see how it could perform in the future. So let's take a look at the chart of Jollibee Food Corporation. So we can see they declined about 10% in the last 6 months. If we look 1 year, it's around 1%. In 5 years, it's even worse with 26% decline. But we can also see in the COVID, it definitely affected the business. It nearly declined 60%, but then it also could recover. So that's a very good recovery for the COVID lows. So if you invested in the COVID lows, you definitely had the profit now. But let's also take a look at the financial because the chart is not telling everything we need to know. So let's take a look at the financial foundation. So for me, it's important we have the revenue growth because we want to have a business that is growing and not a dying business. So if we take a look at Jollibee's revenue, we can see in 2020 it decreased over 28%. So this is because of the COVID, so it's very understandable. But then in 2021 it increased again, and if we look 2022, it increased again over the level of 2019, and then in 2023 it increased even more. So this is very good actually. So we can make the check here. The next thing, which is very important for me, is free cash flow growth. So free cash flow is used to pay the dividend or to buy back shares. So it's very important that we have a free cash flow growth. So if we take a look here, we can see in 2019 it was positive, and then in 2020 it becomes negative. So that's because of the COVID. But then it increased again and becomes positive in 2021. And we can see it increased again in 2022. And in 2023, it increased even more. So that's very good. We can make a check mark here. So the next thing I'm looking for is a free cash flow yield over 4%. Because like I already said, this is how we pay the dividend. So we would like to have the free cash flow yield over 4%. So we take the free cash flow. Here it's about 24 billion. And then we need to look the market cap. So what is the market cap? The market cap is the stock price multiplied with the shares outstanding. So here is the market cap around 250 billion. So this we can divide with the free cash flow, divide the market cap, and then we will get the free cash flow yield. So it's about 9.6 million free cash flow yield. And that's very good actually. So this is also a check mark. So the next thing I'm looking for is debt to free cash flow should be under 5. So what does this mean? So if we have to pay back the debt with our free cash flow, it would take us under 5 years. So now we have to take a look at the debt of Jollibee's, and we can see here long-term debt around 100 billion and the short-term debt is around 20 billion. So we take this together, around 120 billion. Then we divide it by the free cash flow. So now we get around 5. So this means it would take us 5 years to pay back the debt with our free cash flow. And this is quite good actually. So we can take the check mark here too, because It's around what we wanted. So the last thing I'm looking for is shares outstanding decrease. So this means that the company is buying back shares. So it's not always important because some companies, they need to increase the shares to keep growing. So in this example of Jollibee's, we can see the companies increasing the shares outstanding. And that's actually not really a problem because the company is still wanting to grow and to finding more international markets. So it's not a check mark, but I don't see the problem here. So let's talk about the pros of investing in Jollibee's. So we can see they have a strong brand and a very good market position. So many people in the Philippines, they like this restaurant and they are very loyal to this brand. So the second thing would be global expansion. So they could go more international and try to open restaurants in other countries. The third thing is they have a robust financial performance. So they have the revenue growth and also the free cash flow. And the last thing is acquisition and partnerships. So they can buy smaller companies and also do partnerships with big brands like Coca-Cola and maybe Pepsi or something else. So let's talk about the cons of investing in Jollibee's. So the first thing would be economic sensitive. So when the prices go up because of the inflation, less people are willing to spend money for fast food. More people will cook at home to save money. The second thing would be competition. So there are many different restaurant brands like McDonald's or KFC. And the last thing would be operational challenges in international markets. So if they decide to open more restaurants in other countries, they definitely need to understand their culture and operate it in a good way. So this is a challenge for them. So my conclusion would be it's a great company and I think it has the potential to grow more in the future if they go more international and if they really understand the culture of different countries. So I see potential and I like this company. So if you enjoyed this video, please subscribe and like because it means a lot to me and I would like to see the channel growing.